Investment advisory services offered through Global Financial Private Capital, LLC, an SEC-registered investment advisor. Global Financial Private Capital, LLC, and SWAN Capital are independent entities.
What your money would say. Andrew and McNair. Money Talks. Are you listening? Money Talks. Are you listening? Money Talks. Are you listening? What your money would say with Andrew McNair.
We're live here on What Your Money Would Say. I'm your host, Andrew McNair.
And I'm your co-host, Scott Malleck.
And you're listening to What Your Money Would Say, where we take financial ugly ducklings and turn them into financial swans. But what does it mean to be a financial swan? It means to sleep well at night as a retiree. And that's why I started my wealth management firm, SWAN Capital.
And, you know, I started my law firm to help help elder clients with estate planning to do, you know, timely planning for untimely events.
And speaking of untimely events, we're going to talk about some of the hard decisions that you have to make in your retirement. So one of the things that Scott's going to start us off with number one.
So I want to know what the difference between traditional IRAs and Roth IRAs are.
And I get that question a lot. So I think we have to take a brief history lesson about what is a traditional IRA and what is a Roth IRA. So traditional IRAs were invented in the 70s, back when taxes, believe it or not, were 70%, Scott.
Wow, 70%. I mean, I thought I was paying a lot at the highest tax bracket. I mean, 70%.
Yeah, it's crazy.
Is that the highest they've ever been?
It's not. So the average is actually 60% over the last 100 years, and the current top marginal tax bracket is a 39.6. But you've been in there with my meetings with clients, and when we ask families, do they think tax rates are going higher or lower, what do they say?
I mean, it's always going up.
It's got to go higher, right?
The government wants their money.
Right, and they keep on promising more and more benefits, which we like, but we know it comes with a cost. So the average has been 60%. But what's startling is they've been over 90% 14 times in history. And don't take my word for it. You know, go to irs.gov and check out these numbers. But taxes were very high in the 70s. So it made sense to tax defer your savings because hopefully they would go down, right?
Well, let me ask you that, because I hear a lot of people kind of interchange tax defer with tax deductible.
Oh, that's such a good point. You know, many people say, well, you know, my CPA, I actually had a client about 3 weeks ago said, well, you know, I had a rush last December because my CPA said, you know, we're making too much money. And he says, well, you need a tax deduction. Why don't you open an IRA and start contributing into it? Because you'll get a tax deduction. And the reality is the family doesn't get a tax deduction. They get a tax deferral. So, Scott, I'm glad you brought that up. The best analogy I can give you, if you're listening, is the tax on the seed versus the harvest. So if you were a farmer and you were going to plant corn as your crop of choice, you know, which one would you prefer to do? Would you rather pay taxes on the seed, that small corn seed, or would you like to pay on all those bushels of corn?
I would probably want to pay it on the seed. It seems like down the road it's going to be much more expensive.
And the other reality is you don't know what your harvest is going to be. Is it going to be a plentiful crop? Is it not? And what's the tax rates are going to be in 20, 30 years? You know, again, of the last 30 years, 40 years now that IRAs were invented, taxes continually dropped, you know, with Bush, with Clinton, with Reagan. They continually just stayed low and dropped. So if you ask families now where they think tax rates are headed, they think they're going higher. So that's why I say I think it takes a fundamental shift. Everything is cyclical in this world, be it the market, be it the taxes environment. So we have to change our strategy. So when it comes to traditional IRA versus a Roth IRA, we understand that IRAs, we are paying on the harvest, not the seed. Now, Roth IRAs is complete opposite. We're actually paying on the seed, and then the harvest would be tax-free.
So basically, I pay my taxes up front, and then down the road, after I've saved for 30 years, I can pull out whatever I need, and it's tax-free.
Absolutely. And so that's a really nice invention that they did, is finally come up with the Roth IRA and also the Roth 401k at people's places of employment. So if you're contributing to a 401k, please ask your plan sponsor, your company, HR, if they offer a 401k that's a Roth.
Now, I mean, I know that there are caps on the amounts that you can put in there. So give me an example of what the caps are.
Sure. That is one of the sad cons of both of them is when the government gets involved, I guess it gets complicated too.
Of course.
So they have put contribution limits, which are higher on IRAs. They're over $12,000 now per year that you can put into an IRA, while Roth is only $5,500, and you can put an additional $1,000 when you reach your get higher into retirement age. But what's the whole thing I don't like about these plans in general, though, is that they actually even put a contribution to begin with. If I want to save my money, I shouldn't be told how much I can put into it.
Now, for me, someone who's 30, does it make sense? I know we talk about after retirement that keeping all your money in an IRA may not be the best strategy because we have the saying that IRAs are good for retirement planning, but not good for retirement.
So true.
So someone from me, my age, if we have any listeners out there that are still working, would you suggest that we utilize both because of the contribution limits, is there one better than the other? That even
Great
at my
point.
age?
So there's two audiences we're always speaking to, that clients that come in the office. We have families that are still contributing to 401ks and IRAs, and they're saying, hey, well, if that's true and we do believe tax rates are going higher, what do we do? Well, the first thing is you always take the free money. If there are such things as free lunch, and that is 401k matches. If you're not taking the 401k match at work, I hate to tell you, but you're financially crazy because that's free money. So you want to definitely grab that up when you can. But anything above that contribution, you should second guess and reach out to our office to see what other options are available. There are other ways to save for retirement above that 401k match. And so if you do believe tax rates are going higher, maybe we talk about a Roth. Now, there are income limits. So if you're making over six figures, you're going to start to see some phase outs in your Roth IRA contribution limits. But the good news is there are other ways to save tax-free. And again, we encourage you to call our office at SWAN Capital at 850-380-9558. That's 850-380-9558. And if you have any questions about your IRA or Roth IRA, please don't hesitate to call the radio station. This is a live show, and we do encourage questions. So call the show at 478, that's 478-3116. That's 3116, 478-3116. So if you're just tuning into What Your Money Would Say, I'm your host, Andrew McNair.
And I'm your co-host, Scott Malleck.
And we're talking about some of the common financial questions that our clients ask us all the time. And one of that is should I do a traditional IRA or a Roth IRA? And we talked about families that are still contributing to an IRA, that if you believe tax rates are going higher, this may not be the vehicle of choice no longer. Now, we have
Let me interject on that. At what age should I start thinking about potentially taking distributions from my IRA or my Roth IRA?
That's a great segue. So the golden decade is what I call it. So from 59 and a half to 70 and a half, this is the primo time to do what's called an IRA exit strategy. It's a term I coined, and I wrote an article for the Wall Street Journal and Market Watch about it. It's about structuring your 401k or an IRA and unwinding it in an efficient and effective manner so that 10 years from now, if Hillary Clinton gets in office or Donald Trump gets in office, that you have reduced your tax liability for not only your family, but your future generations as well. Because we get a lot of misconceptions, especially in the estate planning world, as you know, Scott, that families think, well, if I leave my IRA or 401k to my beneficiaries, then they won't have to pay taxes.
Yeah, and I know there's a lot of issues with that, especially with depending on the ages of beneficiaries and the stretch out of IRA distributions, and so
it's very complex.
Exactly. So some beneficiaries can actually lose out on what they actually would receive because of the age gaps in the beneficiaries.
Right, and because they actually potentially could put an RMD, which makes that child that's 30, 40 years year old starting to take out money out of the IRA because they're mandatory. So you don't want to put your child in that situation. You know, I always tell families it's nice to give a legacy to your children, but you don't want to give them an inheritance of tax liens either. So that's the difference between a traditional IRA and a Roth IRA. So let's go to the second one.
Well, before we move on, I kind of want to roll back a little bit. I know we talked a little bit informationally about traditional IRAs and Roth IRAs. What is your opinion on the benefits of a traditional IRA or a Roth IRA in general?
Yeah. So to sum it up, the pros of IRAs, tax deferral is in and of itself is a good thing. It's better than, you know, putting your money in a CD that you're paying taxable interest every year. Tax deferral is always better than taxable.
I'm going to interrupt you again. Let me just stop you there. So let's put it in terms of our two audiences. So if, you know, you're talking to somebody like me who's 30,
right?
Obviously it's going to be beneficial for me to put contributions into long-term savings like traditional IRAs and Roth IRAs. But what about at the age bracket? You know, you start to get, like you said, that golden age, the 59 to 70. What is the benefit of either saving or starting to exit, like you mentioned?
The great benefit of creating an IRA exit strategy is certainty. You know, when it comes to retirement, you know, the more things that you can make known decreases your anxiety of being unemployed for the next 30 years, because that's basically
well at night, right?
Exactly. Sleep well at night. Good plug there, Scott. You know, that's the goal, is you're going to be unemployed for 30 years in retirement. You know, it gives me anxiety if I was getting, you know, prepared for that step if you're not planned properly. But basically what an IRA exit strategy does is it takes your current tax bracket, and we can efficiently and effectively unwind your IRA so that if taxes go up to the average of 60% or they go up to 90% like they've been 14 times in U.S. History, then you'll be prepared, because you'll pat yourself on the back saying, you know what, I'm glad I did an IRA exit strategy because I took advantage and took control of my finances and paid the taxes now.
That makes sense. So let's move on to, you know, the differences of other types of planning for retirement with regards to potentially, I know healthcare costs are kind of out of control in this country.
They are.
What's the difference between, you know, long-term care insurance and long-term care hybrid insurance?
Very good question. So let's talk about the state of long-term care right now. So if you or a loved one, maybe an elder parent, maybe you've been exposed to this, assisted living, skilled nursing facilities, or just having a caregiver come to your home is not cheap, right?
Well, let's give an example. What is the average cost of those, you know, those options here in Pennsylvania?
So let's start off with a caregiver. You know, many times I have an 80-year-old client that says, you know what, my kids will take care of me. And then I start asking, you know, what's their medical background? Well, you know, my son is a custodial engineer. He's a janitor. Well, you know, I don't know if he has all the medical background that you want caregiving to you, you know, for you when you're in your 90s and or longer. So there's a lot of disconnect there. And also, until you've bathed the person, it's not for the faint of heart to take care of an elder parent or an elder loved one.
And, you know, not to make light of it, it is a sad reality. And
it is.
And, you know, we all are, you know, it's a potential for all of us to reach that.
Well, it's a luxury. We all hope to get old. And if you get old, you're going to have someone eventually take care of you.
We all, you know, hope to die in our peacefully in our sleep, but
don't always work that way, right?
Exactly. And so being prepared, as you said, and with the state of healthcare, you really got to think about these things.
That's right, because caregiving costs anywhere from about $12 to $15 an hour, and a lot of people don't even make that in Pensacola. So when they start putting out $12 to $15 an hour for a caregiver, that's pretty pricey. The next level is an assisted living facility. So I'm a big fan of assisted living facilities because they give families that social interaction, that cognitive, you know, ability to grow their mind. Because whenever you're sitting at home being reclusive, it doesn't stimulate the brain.
Now,
so
there's I mean, I know in the past there's been stigmas attached with assisted living facilities,
right?
And you said you're really a big fan of them. So I know you kind of mentioned the social aspects. Is there other aspects of reason why you really like it?
Well, they have trained professionals. There's economies of scale. They're in one place. Sometimes they have locked facilities. So I have a lot of clients that, you know, grandma or mom, she's walked out of the house 3 times. She's going into her neighbor's houses. She's stopping cars. Not only is she being a threat to other people, she's been a threat to herself, and we don't want anyone to ever be hurt. In these facilities, there's trained professionals. They're locked facilities. It's not jail. If they're doing cognitively well, then they can still leave and go back and forth, but their meals are prepared better. I've seen people do complete 180s going into these facilities, but they do come with a price tag, Scott.
Of course.
And so they're about $3,400 is the average right now. And many people in their 60s right now are, tuning me off because they think, well, I don't need long-term care yet. This show's not for me. But, if you have a loved one that's paying $3,400 today, you need to ask yourself, how are you going to pay it in the future? Because in 10 short years, it's going up at 4.3% every year. So that means in just 10 years, it's going to go from $3,400 to $5,287.
Now, is that per month, per year?
That's per month, Scott.
Is that for an individual?
That's just for one person. Wow. So imagine what it is for two people. And you extrapolate that 20, 30 years from now when a 60-year-old finally needs that care, it could be way past their income. So you can't just stick your head in the sand like an ostrich approach to long-term care. You have to start planning because not Medicare, not Obamacare, Medicaid, they are not coming to save families in this situation. So if you're just tuning into What Your Money Would Say, I'm your host, Andrew McNair.
And I'm your co-host, Scott Malleck.
And we're talking about common financial pitfalls and questions that families have. And so if you have any questions that you would like to ask on the air, please give us a call at 478-3116. That's 478-3116. Or you just like to schedule a free consultation with SWAN Capital, you can definitely give our office a call, even on the weekends, at 380-2061. That's 380-2061.
I know we're talking about financial, but estate planning and financial advising really do go hand in hand. So if you have questions about estate planning, I am an attorney here in Florida, and I have my own practice here in Pensacola. If you want to give my office a call, as Andrew, I do offer the first consultation is a free consultation. My phone number is 850-403-0351. Again, that's 850-403-0351. I'd be happy to meet with you and discuss anything you need to.
So with the state of healthcare being quite expensive, you also got skilled nursing facilities, which are $6,900 today. So very large expenses. So
you say $1,600 or $6,900?
$6,900,
wow.
$200 a day. So let's talk about what the options are. We can be doom and gloom, but let's be proactive because we got time on our hands and we can start planning. So we kind of briefly mentioned, we talked about the state of healthcare. So what's the real difference between long-term care, traditional long-term care, and long-term care hybrids? Well, long-term care insurance, the traditional kind, it's kind of like car insurance. It really is. You hope you never get in a car accident, just like you hope you never grow old and need long-term care. But it's the same model. You pay into it, but if you ever stop paying into it, then you lose it, which is a really sad thing. The other thing about traditional long-term care that families need to understand is that if you buy long-term care insurance and you pay into it for 20 years like my grandfather did, and he unfortunately passed before the elimination period ever went up, so basically he never got any benefit from it.
So let me stop you there, because I know what the elimination period is, but some of our listeners
don't
know what it is. So explain the elimination.
Elimination period means let's say I buy a 5-year long-term care benefit that pays me $3,000 a month, and I go into assisted living facility. I can't just start taking out those benefits day one. The insurance companies are very smart. They put a 180-day elimination period or 90-day elimination period sometimes that says, hey, you have to wait 180 days before we'll pay out a single dollar.
Wow. Which
is scary. So that being said, my grandfather didn't ever get any benefit from it, and he paid $100,000 of his hard-earned dollars into it, and he didn't get anything from it. And that insurance company kept all the money. And so there are alternatives out there. That's why I always love to share about the long-term care hybrid. We actually just did it for a client last week, and I'll share with you exactly what we did for that family. The family had about $100,000 for herself because she's been taking care of her husband who's had some strokes, but she wanted to protect herself because she knew that, she's a caregiver for a lot of people in her family, like her mom and her husband, but who's going to take care of her? So she said, you know what? I'm going to plan in advance. So she bought a long-term care hybrid through SWAN Capital. And basically, what that did is she peeled off $100,000 of her portfolio. And we took $100,000 and we're getting CD-like returns. So we're getting 2 to 3% for her. But if she ever needs long-term care, she gets a 3 times multiple for long-term care use. So that means that she took that $100,000 and immediately turned it into $300,000 when she finally needs it.
That's impressive. So is with these, these hybrids, is there the similar elimination periods? Do they have the same kind of
Good question. So it depends on the company. Luckily, I don't work for any life insurance company. I don't work for any Wall Street firm or brokerage house. I work for my clients first, and then I work for my staff second and me third. So I can pick any different company that works for that family. If they don't want any elimination period, we can work to achieve that. So I'm glad you asked.
So what's the best analogy for, I know you gave the auto insurance analogy for the traditional long-term care. What's a good analogy for that?
I guess the simplest analogy I can give, and it breaks down like any analogy ever does, is a health savings account. You put your money into a health savings account for medical expenses throughout the year, but if you never use it for medical expenses, then it goes to tax deferral savings, and you can spend it or add it to your part of your retirement. So we're going to take a quick commercial break, and we're going to talk about a really hot topic, very controversial topic. So you want to tune back into what your money would say. We're going to talk about variable annuities and annuities, the good, the bad, and the real ugly. Welcome back to What Your Money Would Say. I'm your host, Andrew McNair.
And I'm your co-host, Scott Malleck.
All right. So in this show, we talked about some of the common financial questions and the terms that families want to know more about. And so we talked about traditional IRAs. We talked about what's the difference between a Roth IRA. We talked about long-term care insurance versus long-term care hybrids. And then the next thing we're going to talk about, which is a very controversial topic because people own them and a lot of people try to sell them to people, is a variable annuity versus a fixed annuity. What
isn't? I personally, I'm an attorney. I'm not a financial guy like you. So explain to me in layman's terms what an annuity actually is.
So annuity is a contract between an insurance company. So it's an investment that insurance companies make. So insurance companies make 2 kinds of investments. They make life insurance as an investment or as a planning tool, and then they have annuities, which are the opposite side. So that's the difference between the two.
So, I have clients that come in and they tell me their financial stuff when I'm dealing with their estate planning. And, I've heard people give me horror stories about annuities. Are all annuities exactly the same?
Absolutely not. None is created equally. And if I had 10 of them on my conference table, I'd probably honestly throw about 9 of them off the table because a lot of them are junk and they're sold to people. You should never be sold an annuity because it doesn't make sense for a lot of people. Sometimes it's okay to buy one if it makes sense for you. One of the reasons it doesn't make sense for a lot of people, either a variable annuity or a fixed annuity, is about liquidity. Most families need access to their money sometimes, and if you place your assets into an annuity, it by definition has some strings attached. There's surrender charges. Now, Florida does have mandatory statutes where you can take out 10% every year out of your annuity, but sometimes you can get some severe penalties.
So they have some liquidity, but they're not 100% liquid.
Exactly, like a brokerage account would. I have, unfortunately, some families that will place, some of their brokerage accounts that they were 100% liquid. They were going to buy a house with it, and someone said, well, I can guarantee you a 7% rate of return into this product, and they move it in there, and then they say, oh, my gosh, I can't buy my house for like 10 years. And that's a tragedy, and it shouldn't happen.
So what's the difference? We talked about variable versus fixed. What's the difference between a variable and a fixed index?
The good thing is us financial advisors and wealth advisors, we sometimes can talk over people's head, which is what I never want to do. I want to make it simple for you because the truth is good enough.
Simple guy from Cantonment.
It's just a simple guy from Cantonment. What can we do? So a variable annuity, the definition is in itself. It's variable. So that means it goes up and down with the market. And there's 2 values you got to track in your variable annuity. An income value, which means like if I put in $100,000, a lot of people sell it just off the income value. They'll say, well, I can guarantee you a 7% rate of return. So they'll show you that 100,000 becomes 200,000. What's sad is families think they can walk away with that 200,000, Scott, but the reality is it's an income value, which means you can turn that into a pension for like $500 a month for the rest of your life. And families are like, well, that's not what I was told. And I'm like,
I mean, it would take forever to get 200,000 back at 500 a month.
Exactly.
Wow.
And so that's why you definitely want to get a second opinion. If someone's telling you need to buy an annuity, a second opinion doesn't cost anything here at Swan Capital. And like I always share with families, it's impossible to get a second opinion from the person that gave you your first. So if someone's telling you need to buy an annuity, give our office a call at Swan Capital at 380-9558. That's 380-9558. So if you have any questions about a variable annuity or a fixed annuity, and you just want to ask your question right now, it's on the tip of your tongue, you're not ready to come in, but you just want to ask a question since we're here, this show is live. So call our radio show at 478-3116. That's 478-3116. So a variable annuity has the income value. They also have an account value, which goes up and down with the market. The real thing that people need to understand about variable annuities are that I have horror story after horror story is those fees that are inside of a variable annuity.
What do you mean I have to pay fees on things that I buy myself?
Oh, it's not people say, well, I didn't think I was paying any fees. And unfortunately, I have to call the company and say, hey, what is this client paying? And I always have the client sitting there so they understand what they own. A lot of us buy things, but we don't understand what we own. So I sit them down and I ask the person, the representative, and they'll say, well, the M&E fee is 1%. I'll ask them, well, what's...
Well, for us laymen, what's M&E?
It's a special fee that covers any admin expenses and mortality expenses for the insurance company. So I'll ask them, I'll say, what's the M&E fee for short? And they'll say, well, it's 1%. Then I'll say, well, what's the sub-account fees? Because a variable annuity has a bunch of sub-accounts. It's kind of like a mutual fund inside of it. And they'll say, well, they average 1%. Then I'll say, okay, well, what's your income rider fee? Well, it's 1%. So then I have the client scratching their head, and they finally get it. They're saying, well, 1 + 1 + 1 is 3%. You're telling me I'm paying 3% on my money to have it there? And I say, unfortunately, that's the case.
And most often they're not making anything more than 3%. So they're earning.
Well, the S&P is flat right now, so a lot of families are getting killed by their fees right now. I'll tell you, this is a story literally 2 weeks ago. He said, I took my mom's money to this guy. I took my money to him for my retirement from the police department. And he said, I even took my girlfriend's money to this guy. And I said, well, let me see it. And it added up to 3.8% in fees. And he said, well, I'm doing real good. I said, yeah, the markets went up for the last 3 years, but you're locked into this thing for a lot more years. And what's sad is you're going to be practically partners on your own money.
It's terrible.
It is.
So what is a fixed index annuity?
So a fixed annuity or a fixed index annuity is basically it takes the variable off the table. So your money is what we call correlated to the market, but it's not in the market, which is really cool because let's say the S&P is at 2,000 and next year it's at 2,500. Well, if the market goes up, they credit your account. But what if the market goes down? If the market goes down, then you don't get a credit. You get a zero. And sometimes the zero is a hero if the market goes down 30%.
Of course. I mean, if it goes down 30%, I'd rather have a zero loss than a 30% loss.
Exactly. But again, you should always get a second opinion on a fixed index annuity or a variable annuity. And you want to speak with people that understand them other than just the person that's trying to sell them to you. At Swan Capital, we don't sell anything. We don't work with everyone either. We do give true financial advice. And as a fiduciary, I have to be in the best interest of my clients, not just what's suitable.
So to kind of paint a picture of what the benefit of the fixed index is that it's basically safer. There's more security involved.
It is,
and so you're either gonna you're not gonna lose anything, and you're only gonna. Is there a cap on how much you can make though?
Absolutely. So again, there's no such thing as a free lunch, and it could be that's too good to be true. You mean I can be in the market, but I don't lose any money? Well, the reality is what they do is If the market goes up, you get a percentage of that. If the market goes down, well, you get a zero, or you never lose any money, which is great to know. But no, you don't get full what we call participation.
So if it goes up 40%, I don't get.
You won't get all 40,
okay.
But you could potentially have clients that got 15%.
Okay.
So there's ways where you can get a very high return without the risk.
So when we're talking about variable annuities and fixed annuities, I know you kind of mentioned is it a good investment for everybody, or
no? And I have some families, and I'm glad you asked, that say, well, I heard that was for younger people, not for retirees. No, they were actually designed for retirees. They were designed to give you safety of your principal with a chance for growth. That was the whole reason they were created. But again, you need to keep in mind that if you need the money, all the money tomorrow, it's not a great investment for you. And the other thing you need to keep in mind is fees. So if you're comparing apples to apples, let's be fair. A variable annuity can have 3% or more in fees sometimes. A fixed index annuity does not have any fees. So right there, you can be out the gates making money.
So what's the reason? Is it because it's not managed? Is that really what the difference is? Is that because it's fixed, it's not managed, so there's not as many fees? Or
yes,
okay.
And because they just buy options versus tracking individual what we call sub accounts, which are like mutual funds and a variable annuity. So it's very complex. So if you have any questions and you just don't feel comfortable about asking them on the air, give our office a call at SWAN Capital at 380-9558. That's 380-9558. And if you do have that question that you want to ask live on the air, we'd love to hear it. And you can call the station at 478-3116. That's 478-3116. So let's move on to the next one, Scott.
So I know we've been talking about a wide variety of different types of investments. Is there investments that aren't necessarily in the market that are more secure? Like, I know we talk about CDs versus bonds often. Can we talk about the safety of these
sure.
different devices?
So certificates of deposit are what CDs stand for.
I actually didn't know that.
Oh, well, there you go. And so they're held at banks, and they're a great little tool to earn a little bit more interest than a savings account. Now, back in the good old days, CDs were earning 5-12% back in the 80s.
Making 5% from our savings accounts at the bank?
More like 0.05, right? So CDs were a great investment. You do have to tie up your money for a little while, sometimes 3-year increments, 1-year increments, 5-year increments, and that's you just got to keep that in mind, or you'll face a penalty, kind of like those annuities work as well. So with those CDs, they are taxable interest. So every year you will get a 1099-R, and you'll have to pay taxes on that interest every year, even though you can't access it, which is kind of weird. So CDs are backed by the government.
Government's always getting their money. Man.
Oh, government's getting their money.
About this.
Woo, they are. They don't forget a payment. So banks have these, and banks, a lot of their investments are FDIC insured, which is a great thing because it gives you the security that as long as the government can hopefully pay its bills, they'll be able to provide you some interest. Now, what I've seen, which is and hopefully this is not your situation, is a lot of families are frustrated with how much CDs are paying, and they're starting to place their money in bonds. And so bonds are basically loans for companies or cities, and they say, well, I give you an IOU. I'll give you a bond. You give me $1,000, and I'll give you, this payment back, and when that period's done with, I'll pay you back off. It's basically what a bond is. We can overcomplicate everything, but that's in its simplistic form what it is. So the real question is, are bonds safe?
And that was the question I was actually leading to is, what's the safety feature involved with bonds? Yeah, obviously they're backed by the city or whoever the state, whoever you buy them from,
or the company. Yeah,
the company you buy it from. Is there guarantees placed with them?
No, not always, and they rate bonds too. I have families that say, I got some very safe bonds in my portfolio, and then I do a portfolio analysis that we offer for free for families, and they don't realize that they're owning junk bonds. And you know what junk means? It's a pretty good Wikipedia term to look up. It's junk. A lot of times they're not strong companies, or they're cities that have problems paying bills. Garson Point was a bond. And so do many people go across Garson Point? Yes, but not enough. That's why the toll's $3.50. So you got to keep that in mind is the rating of the bond.
So we also talked, I mean, you kind of mentioned interest rates and how they've really dipped on CDs. Do
Right.
interest rates affect bonds?
Wow. That is probably one of the misconceptions about bonds, that because they're safe, then I'm protected. So one of the things that makes bonds kind of a scary time to own right now, and that's why I'm just urging families, if you own bonds right now, to come in for a second consultation, because where are interest rates right now, Scott?
They're really low.
Really low. I mean, the U.S. Treasury has their bonds, the 30-year Treasury bonds, at very historically low rates right now. Over the last 30 years, since the 80s, bonds have continually dropped, which provides a really sweet bull market for bonds. The problem is that dance can't last forever. And so if
the bubble's going to burst like the housing market in 2008.
I actually just had Rick Harper on the radio show, and we've talked about this commonly. People say, well, where's all this free money that the government's been pumping into the economy? They've been printing money. Where is it going? Is it going to get us hyperinflation? No, he was saying, no, I'm concerned about asset bubbles, and that's exactly what you're alluding to. A bond bubble could potentially be out there, because if interest rates spike very quickly, inverse relationship between bonds and interest rates. It's kind of like a bond teeter-totter, if you will. Bond prices are on one side and interest rates are on the other. So if interest rates rise real quickly, then you could see families see actually huge losses in their bond portfolios.
I didn't know that.
Yeah, and it's scary because bonds were sold as something safe, as an alternative to stocks. So again, if you have bonds, please give our office a call at SWAN Capital at 380-9558. That's 380-9558.
Well, so, I mean, I know we just talked about, it seems like there's a lot of negative connotations associated with CDs and bonds now with regards to interest rates and safety. Is there any time where you would recommend them?
Absolutely.
Well, I always thought CDs were liquid, but I thought about it after you said it with, I have clients that tell me, well, I have my CDs, I'm pretty liquid, but they do have surrender fees too if you don't wait that entire time. So, what are some of the benefits of having a CD or a bond? So
both of them can be sometimes illiquid. I had a bond that could have been sold for a client, but after looking at it, they were going to lose $25,000 to sell their bond. They had to wait 3 years before they can change. And I told the client, I said, I hope interest rates don't rise, or you're going to be in a real bad situation. Also, CDs do have penalties. You typically, they're not as bad if you've held them for a long period of time. But if you just put your money in a CD and you take it out, you're going to get hit with a penalty. Now, a lot of people won't tell you, though, that CD penalties are tax deductible. So that is good for tax time. But again, you want to just keep yourself careful about not tying up your money too quickly.
Very good. So let's move on to mutual funds and ETFs. What's an ETF?
So mutual funds versus ETFs. So an ETF is just another one of those abbreviations that we got to remember, like we don't have enough, right? An ETF is an exchange-traded fund. So this is very controversial, and I'll probably get some phone calls at the station, but I'm just going to tell you the truth. I had a colleague just write an article for U.S. News, and it was mutual funds are for poor people. And a lot of people say, oh, hold on, I'm not poor. I own mutual funds. Let me help you understand why I say that. Mutual funds are for poor people because when mutual funds were created, their whole goal is to give you fractional ownership of a company. So what does that mean?
If I buy a mutual fund, or if I buy into a mutual fund, if it's essentially buying fractional ownership in stocks.
Right. Because, when you're starting off at college, you can't buy Apple, that's $300 a share. You can't buy Berkshire Hathaway, the B stock, at $3,000 a share. But you want to own that company, so you buy a mutual fund that owns a percentage or fractional ownership of Apple. And you buy into it every month with your dollar cost averaging strategy. And it makes sense when you're first starting out. But once you've amassed a portfolio of $150,000 or more, a $500,000 portfolio, why would you ever have mutual funds? Because mutual funds means that you have fractional ownership in these companies, when in reality, you could buy the companies yourself.
So, let's let's put this in perspective. What is there a benefit to purchasing mutual funds? I know you said it's for poor people. I understand that. I bought my first mutual fund when I was 14. Clearly, I was poor then. So,
well, with your allowances, is all you can do with your allowance at 14, right?
Exactly. And so, my question is, why are you saying that the fractional ownership is bad?
The fractional ownership is bad because it's kind of like buying your groceries at Tom Thumb. Yeah, you could do it, but wouldn't it be cheaper to buy your groceries at Walmart where you can buy them individually? Basically, fractional ownership is a convenience, and you're paying for that. It's startling when I do a fee analysis and a portfolio analysis of potential clients, and I show them, and I hate being the bearer of bad news because these people trusted people that they thought could lead them in the right direction. And I show them that, hey, I hate to break it to you, your mutual funds, you're paying almost 4% in fees to own this mutual fund. And their mouth drops, and they're saying, well, I only made 8% last year. And I say, well, basically, you got a partner for your own money.
Wow.
And so it's a convenience factor that if you're built up enough nest egg, you can work with investment firms like ourselves that have avenues to institutional investing, which means you can invest like pension funds, and you can have the access like they have to portfolio managers that otherwise you wouldn't be able to have.
So but essentially, in the long run, the cost of owning mutual funds is actually more expensive in the long run than if you are able to afford purchasing outright shares.
Exactly.
Okay.
And so that's why I encourage families to second guess their portfolio strategy or the advice they're getting if you own a mutual fund. So if you look through your IRA, you look through your brokerage statement, and you see a mutual fund, then you need to second guess it. Now, your broker may say, hey, mutual funds have been, here's the average. This is what you're going to earn. Plenty of my clients with $1 million portfolios own mutual funds. They don't realize that the wool's been pulled over many of their clients' eyes because they're paying high fees. That's why he's, scared to drive around his car into the front parking lot because he's charging an abnormal amount of fees. And I'm all about making a living, and I make a good living myself, but I don't have to make my living by persecuting my clients through fees.
So my question then is why are the fees so high associated with mutual funds as opposed to, for say, ETF? So, I guess my question is: there buying and selling? Is there constant buying and selling? Which is why the management?
Good question. This is one of the small reasons why there's so many fees in mutual funds. But I'll just give you an example. There's called stock intersection, and people are like, "Gosh, that's a long word, right?" Stock intersection is basically like having two quarterbacks on the football field. So if you have a XYZ mutual fund that is buying Apple stock, and you have ABC mutual company selling Apple stock, one's buying Apple and one's selling Apple, it doesn't take a genius to say, am I paying for that? Am I paying for two people to do the opposite things?
So you're buying, selling the same stock that you already own.
And netting no gain, but you're paying the fees to sell it. And so people say, well, that couldn't happen in my portfolio. But let's take a step back. Do you think that mutual fund company is calling all of their clients and saying, hey, do you own this other mutual fund? Because we're about to sell Apple. Is your other mutual fund buying it? They don't do that. So basically you got two quarterbacks. One's throwing a Hail Mary and one's running it up the middle. And so it is a circus in many people's portfolios. And this can be avoided by working with an investment advisor that specializes in institutional investing. And so you can call SWAN Capital to give you a free portfolio analysis. And what we do is we sit down at that portfolio analysis, and you learn more about your portfolio than you ever have before. And if you still say, Andrew, I feel like I'm doing good, and sometimes I even say, hey, you're doing great. Stay with your broker that you've been with for 10 years. He's doing a good job. Everything looks fine. But wouldn't you would like to know if you were making a mistake? When would you like to know that?
I know that if I'm making 8%, but I'm paying out 4% in fees, that I'm going to definitely want to know that. If it's my money, I want to make the money on it.
Exactly. And let them never forget whose money it is, because it's always my client's best interest at first is what I'm thinking about. So you can call our office at 380-9558. That's 380-9558. And you can schedule that anytime but you can call this weekend, and we'll be happy to call you back first thing Monday to schedule your free portfolio analysis. But if you have questions about mutual funds or what is ETFs, call the station. We're here right now. This is a live show at 478-3116. That's 478-3116.
A lot of my clients, and it's a question that I have, a lot of my clients are elderly clients. I mean, that's just the inevitability of estate planning. Is most people don't think about estate planning when they're in their 30s and 40s.
No.
And so the reality is that a lot of my clients are elderly, and one of the questions that I get often is related to Social Security is, what age should I start taking Social Security? Should I take it at 62 or should I wait?
Good question. So 62 versus 70, and it's becoming an age-old debate. I mean, it's been happening for a long time as people say, well, is Social Security going to be there? Have you ever heard that in our office?
Oh, well, the question for me is, I know it's probably not going to be there for me. I mean, I'm only 30, so you got 35 years. The reality is that I'm not going to have Social Security to rely on or to even have as a benefit down the road, because our liabilities are so high in the government that we don't have enough money to pay all of our liabilities.
And we had to be doing doom and gloom, but Social Security, let's just talk about the facts. In 2030, they're going to start running out of money, and then they're going to have to make some really tough decisions, because we know the government doesn't make proactive decisions. They kick the can down the road. So in 2030, they're going to start running out of money, and then they're going to have to start making some severe changes. The good news is if they increase taxes, which is not good news for us, they could prolong this problem. They could prolong this inevitable problem. But the good news is if Social Security ran out of money tomorrow, they could pay out 75% of the benefits that they owe. So Social Security will always be around, but it probably won't be around for us. Working professionals that make a good living are going to be probably penalized.
So my question then is, what age, I guess a benchmark is somebody need to start thinking about, Social Security isn't going to be there for me?
I think if you're 50 and under, you need to start taking a stronger glance at Social Security. If you're 50 and 55, more than likely the Social Security that you know today is probably going to be the one in your retirement. And it's just because if you study history, government does make changes, but they also try to grandfather people in that were promised certain things. So does it make sense to wait? Absolutely. Many of my clients say, well, I don't want to wait till 70 to retire. Just because you elect Social Security when you're 70 doesn't mean you're waiting till 70 to stop working. It just means your income, when you become retirement unemployed, has to come from somewhere else. And a lot of advisors are not going to talk to you about this strategy, because why do you think, Scott?
They don't make fees on it.
Right. One, they don't make fees for doing the planning. And second of all, if they take assets out of their management where they make their living, that's not good business for them, because they're not making the money. But sometimes it's the best thing for my clients to actually take money from my firm to provide income for their family while they let Social Security accrue their benefits.
So I guess to give me an example of people that are listening, is there a good rate of return?
Oh, it's fantastic. It's a rate of return that if anyone says, well, we can beat Social Security by investment returns, you should have them sign that on a piece of paper and then sue them later, because that's what you should do. Because I can't compete with that on a guaranteed basis. From 62 to 70 is a 6% rate of return. 6%, which no one can guarantee. Yeah, no one can guarantee that. I mean, the market will probably do that, but you can't guarantee that. And from 66 to 70, it's an 8% rate of return. So the market minus advisory fees and fees, you can't beat that. And so if an advisor...
Of course, earlier I was paying 4% on my 8%, so I was only netting 4.
Right. So again, if someone tells you shouldn't do Social Security planning, or it's not that big of a deal, you need to really second guess and maybe fire that advisor. So what did we talk about today? We talked about a lot of things, didn't we, Scott?
We did. We had a lot of different investment strategies.
So if you will highlight, if you'll bring them up and we'll talk about some of the highlights.
So I know we talked a little bit at the beginning about traditional IRAs and Roth IRAs. Give us the benefits.
The summary here is, do you think tax rates are going higher or lower? If you think they're going higher, then a traditional IRA, if you own one or you are contributing one, you need to get a second opinion, because if tax rates are going higher, you're putting your assets into something that you don't know what the tax rate's going to be in the future. And if you already have your life savings in an IRA, have you built a strategy to efficiently and effectively reduce your tax liability in the future? Because the last thing you want to do is pass on your life savings to your children or beneficiaries and pass along a big tax bill too.
And I know we also talked about the state of healthcare and preparing for the paying of those healthcares.
We did
down the road, and so kind of tell us again the benefits of
the synopsis there. Absolutely. So if you're just tuning in to What Your Money Would Say, I'm your host Andrew McNair,
and I'm your co-host Scott Malleck.
And on What Your Money Would Say, we're trying to help families go from financial ugly ducklings to financial swans, so you can sleep well at night. And one of the things that keeps a lot of families up at night is the state of healthcare. You know, right now it takes $3,400 a month to pay for someone to live in assisted living. In just 10 years, it's going to be $5,287. Most of the time, that wipes out people's income, Scott.
Well, I know the Supreme Court just upheld the federal subsidies of Obamacare. Is that not going to help me pay for?
Yep. A lot of people are hoping that Obamacare, Medicare, or Medicaid is going to save them when it comes to long-term care expenses. And the reality, it's not. It can't do that. And the last thing we talked about is variable annuities and fixed index annuities. If you're buying an annuity, it's not right for everyone. Please get a second opinion by calling our office at 380-9558. That's 380-9558.
And if you have any questions about estate planning, feel free to give my office a call at 850-403-0351.
See you